Hey everybody, it's Ken, and I cannot wait to talk to my good friend here, Garrett Sutton. So Garrett and I have known each other, 20 years? At least, something like that. What we really wanted to talk about was this. Now, Garrett, why don't you explain what this is? Because this is straight from the IRS guys. This is the Dirty Dozen. They do it every year. Beware of the abusive tax avoidance schemes. So let's talk about that, because this is a big deal.
It is a big deal, Ken, and the IRS feels the need to put this out every single year because there's so many promoters out there letting people get into these shady tax schemes.
Yeah.
And, a lot of times you're going to deal with someone who won't be there the next year when you're in trouble.
I see these all over the internet.
Yeah.
Like you see them on TikTok, Instagram, and they're short little clips, and they're like, you can avoid tax. I always tell people, it's that, the purpose of, what we're doing here is to protect your assets. It's not to pay tax.
Right.
Right? That is a big difference. People think, I'm not going to have to pay tax. That's not how it works, folks. Right?
Exactly right. I mean, we do not want you getting in trouble,
No.
ruining your life, your family's life, going to jail. The tax code allows you to minimize taxes.
Yeah.
And that's fine.
And by the way, you use a CPA for that? Not an attorney? You don't use an attorney to try to avoid tax. I mean, the CPA and the attorney do work together
Right.
a lot, and that's,
and you don't use the CPA for asset protection because CPA stands for cannot protect assets.
Let's talk about some of these dirty dozens, because this is very interesting. What are some of the dirty dozens?
Well, the one that really stands out to me is the Maltese retirement plan, where these promoters, including some lawyers out there, are encouraging people to set up a retirement plan on the island of Malta and avoid U.S. tax by doing it. And the IRS has had so many people claim that they don't have to pay U.S. taxes because they have a retirement plan in Malta that they added it to the list this year. So it's risen to the top of being a problem. And I think that all these lawyers out there that are promoting this scheme to their clients are having a tough time.
Okay, so before we jump to the next topic, you guys need to understand there's a couple things going on. One, there's all kinds of people promoting this online.
Yeah.
There's all kinds of people doing it, and the IRS says we're going after it. So hopefully you guys see the problem here. These are not opinions, right? Right?
Exactly.
The IRS themselves have said this is a problem.
Right. And so there's so many schemes out there. They have to do this every year, the top 12. And so if you're on the internet and someone's promoting this tax-free scheme and it doesn't sound right to you, but they're very convincing, just know that this scheme could be on the IRS top 12, the Dirty Dozen, in the future. So you've got to engage in critical thinking.
By the way, it's on there now.
Yeah.
We know that.
Right.
But the one thing that's always saved my butt is the CPA handles tax, the attorney handles asset protection.
Right.
Don't take tax advice from the attorney, and don't take asset protection advice from the CPA.
Especially that one.
Yeah. Well, you know what I mean?
Because
like they are two different things, and sometimes you like them arguing.
True. And I like getting on the phone with the client, the CPA, and myself.
Right.
And usually in one phone call, we can solve everything.
Yeah.
Right. But to have the attorney say, well, that's a CPA question, call your CPA, and you're bouncing back and forth, just get everybody on the call all at once and solve everything.
That's a very good point. I know as I move money around and we've done trusts and stuff like that, we get everyone, we get the attorney on the phone, the CPA on the phone, we get everyone on the phone, and we come up with a strategy. Then it doesn't take very long.
No.
But I do think that if the CPA, who has a fiduciary obligation too, is on a phone call with an attorney and the attorney saying something that CPA doesn't agree with, that it's going to come out in that conversation.
It should come out.
It should come out in that conversation.
But if you listen to the CPA for asset protection advice, I've had so many clients come to me and say, well, my CPA said I was starting out. I couldn't afford an LLC. They're not expensive. But the CPA says just start out with the property in your individual name. That is really bad advice.
It is. So before we go so much deeper into these dirty dozen, let's talk about the basic problem that we have, which is people holding things in their own name.
Right. That is a huge problem because when that tenant sues not if, when the tenant sues, they can reach all of your personal assets. So you hold a duplex in the name Ken McElroy, right? And the tenant sues, they can get the equity in the duplex and they can get all of your personal assets. By simply setting up an LLC, transferring title into the name of the LLC, they can get the equity inside the LLC, but they can't get beyond to your personal assets. And so it's just so easy at the start.
It is
to set up an LLC.
There are certain buckets of money that you have, and they're all separated. So you got maybe equity in your home, maybe you've got equity in a piece of land, maybe you've got a business, maybe you've got, some assets in the stock market or gold or silver or whatever it might be. So you have stuff all over. And if you buy something and it's in your name and you get sued, then they have access to all of those things. And that's what's important to understand.
Right.
And what you're trying to do is put, a force field around the thing that you buy.
Right.
Essentially.
And we want to segregate assets from each other. So if you put 10 properties into one LLC, the tenant suing over the first property can get the equity in all 10.
Right.
So we don't want to have too much in one LLC. We want to split them up so that you don't have a target-rich LLC.
Right. So that's the basics of asset protection, is that you guys might be surprised, but I believe, and I have to think about this, I don't think I have one thing in my personal name, is that you're trying to segregate all this stuff so that people don't have access to all of it, right?
Right. And so we have a lot of clients that will have a brokerage account with, a couple $100,000, $1 million or more. And if it's in their individual name, say at Charles Schwab, they get in a car wreck, someone could reach that brokerage account. It's very easy to transfer all the brokerage assets into an LLC.
Yeah.
It's not a taxable event. You're just transferring it from your name into your LLC. You haven't sold the securities. And it provides excellent protection. If you ever get sued, they're going to have to fight through a Wyoming LLC to get at those assets, and that is not easy.
So let's talk about that, because I hear this a lot. Like, well, the bank won't let me, loan to an entity that, has never been set up. I go, well, why would they? Like, there's no assets in it, right? So there's a lot of confusion around when to transfer things into an LLC. And you said one really key thing that I don't want to pass over, which was that it doesn't include the securities. Can you explain the difference?
Well, you're going to have one LLC for the real estate.
Right.
And when you borrow money, of course, they're going to want your personal guarantee.
Right.
They're not going to accept just the property.
Right.
They want your personal guarantee. And that's true for every bank out there.
That doesn't change.
That doesn't change. But that obligation is just between you and the bank.
Correct.
That doesn't mean that if you set up the LLC properly, that a tenant can go after you personally. Yeah, just personally guaranteed with the bank, not with the tenant.
Yeah, and a lot of people have asked about that due on sale clause and all of that stuff. I've never heard anybody actually exercise it. You're just protecting the equity that.
Well, and the other thing is you haven't sold the property. You've transferred title from your name to your LLC name.
Right.
There's no sale there.
Which is owned by you.
Right. And so the FHA has this term that everybody should remember: continuity of obligation. So when you borrow money, you give the bank your personal guarantee. The bank has a first deed of trust on the property. When you transfer title into the LLC, there's still this continuing obligation to pay the bank. You have the personal guarantee. The bank still has the first deed of trust. So the bank's position hasn't changed in that scenario. In fact, I would argue the bank's position is better because it's less likely you'll get sued if property's in an LLC.